recipes for technical trading success in Cook's Kitchen.
How does the S&P 500 make new highs this year without an increase in earnings? Hey, we're in the middle of an earnings recession. Things have sort of bottomed out. Investors are looking ahead. What it's going to take is an increase in the PE, the multiple for the market. And how does that happen? I'm going to show you the math and the machinery of new highs. And a lot of it depends on the Fed. We're going to look at this in terms of the equity risk premium. And this is really about asking how much compensation do investors need over the risk-free rate. So what's the risk-free rate? Well, we'll use the 10-year Treasury note, yielding about 1.6% right now. Pretty low as investors pile into U.S. bonds. And the S&P 500 earnings yield is 5.5%. I'm going to show you where that math comes from in a second. The difference between those two yields is what we call the excess return, 3.9%. That's how much compensation investors want for their risk, meaning I'll buy equities, but how much better a return am I going to get in the stock market versus the bond market? That's the equity risk premium, currently close to 4%. So let's see how we calculate the earnings yield on the S&P 500. That is the core component of the equity risk premium. Hey, it's just the inverse of the PE. So let's do the math. If the S&P is going to earn $115 this year, that's a pretty close estimate for 2016 earnings, and this is not non-GAAP. We take and divide that by the price level. We'll use 2075, about where the index closed yesterday, and that's where you get the 5.5% earnings yield. This number has been tracked. It's continuously tracked. So I'm going to show you a chart going back to the early 60s of what this difference between the earnings yield and the 10-year yield looks like, what that equity risk premium looks like. This comes from a quant named Scott Granis. He runs a blog. He has one blog, scottgranis.blogspot.com, as you can see here in the lower right. But he also calls himself the Calafia Beach Pundit. Calafia Beach somewhere in SoCal, I believe. So here it is. You can see on his title over here, S&P 500 earnings yield less the 10-year Treasury yield. That's the math we just did. And this is going back to the early 60s. So you can see that, hey, this thing spends a lot of time around 2 and 3%. But in the early 80s, when interest rates were still relatively high, investors were willing to accept a negative equity risk premium, meaning interest rates were so much higher than the earnings yield on the stock market that that was the price of risk back then. So I want to flash forward all the way up to here. This is showing 2012 down here, but we actually go into probably 2014 on this. But what's worth noting about late 2011, early 2012, I just want to highlight this spike up here where the equity risk premium was over 6%. How do you get there? Well, at the time, you may remember, we were in the middle of a correction in the fall of 2011, and the S&P 500 fell to 1,100. Well, and that's where I said, hey, this is an extreme value area for the S&P 500 because forward earnings estimates were still about $100 for the S&P in 2012. So if the S&P was at 1,200 and it was going to earn $100 EPS in 2012, find the earnings yield there. That's 100 divided by 1,200, and you got 8.3%. So that was a really high earnings yield for the S&P 500 in late 2011, early 2012. 8.3%. Take away, so let's say the Treasury was trading, say 2.5%. That's how you got a 6% equity risk premium. All right, so, there is no set number where this should be. It's all about what investors are willing to accept. What kind of compensation do they want for the risk? Sometimes they'll take negative compensation. All right. So now I'm going to show you the mathematical machinery of new highs. And it begins with my number one secret of Wall Street: they have to buy. Now, this is not a conspiracy. This is the way things actually work. Picture fund managers who have a mandate and a charter. Let's say they're long only. What are they supposed to do with new money coming in? They're supposed to buy stocks. Now, it doesn't mean they can't sit in 20% cash, but they're probably not going to sit in 40% cash. They're going to put their money to work, so they're constantly looking for places to put money in equities, maybe even in ETFs. We'll get to that in a minute. But the bottom line is they have to buy. The next component of this mathematical machinery is QE. Obviously, what the central bank is doing with quantitative easing and ZIRP, zero interest rate policy, or LIRP, low interest rate policy, it's unprecedented, right? We had an unprecedented historical, financial crisis, and now we're in year 7 of extremely low interest rates. And it's going to continue. I'll tell you why. We got some news this morning about that, how long low interest rates could continue. But the point is that the Fed is anchoring rates extremely low. 5 years ago, I called it, an artificial manipulation of the yield curve. It's still going on. It makes a difference in terms of what kind of yield you're going to get, and that's why the 10-year is at 1.6%, and that's why you have an equity risk premium near 4%. Okay. Third component is the other central banks. The BOJ and the ECB, they love TINA. Who is TINA? TINA is the acronym that we use. There is no alternative, meaning no alternative to U.S. equities. So as long as the BOJ and the ECB are printing money, devaluing their currencies, they tend not only to keep our interest rates low, but to drive money into stocks. And all these things are working together when large investors who use quantitative models plug this data into their models. It tells them, listen, we've got to put some of this money in stocks and stay in stocks. All right, number 4, the equity risk premium. We've talked about it. It's near 4% right now. Investors are being compensated. It drives money into stocks. And lastly, we could talk about the dividend yield. If you just bought the SPDR ETF, you're earning 2.1%. That's 50 basis points higher than the 10-year. That also is part of this machinery driving money into stocks. So now let's talk about the news we had this morning, why interest rates will stay incredibly low for longer than anyone expected. Bullard of the St. Louis Fed, who is not a voting member, but he's a very articulate Fed member, and he was an original architect of Bernanke's QE policies. So he was extremely dovish for a long time. Then last year he started saying, we need to get off zero. Well, they got off zero. But this morning he's saying, hey, we may not hike but one more time into 2018. Okay, so by the end of 2018, there might only be one more hike. That's 2.5 years. He's saying it's possible we might only hike one more time. Why would he say that? When before he was saying we need to get off zero and the market expectations are not realistic. When I say market expectations, I mean Fed funds. The probability of Fed hikes was forecasted to be very low by actual players in the interest rate markets. So he thought that they needed to come up to where the Fed was and be more hawkish on the economy. Now he's saying the opposite. He's saying the Fed is talking too hawkish and not in line with the reality of inflation expectations and GDP growth. And that's the environment we're still in. It's still the low and slow plow horse economy that necessitates the Fed to be low and slow, right? 1.5% GDP just going along nice and slow, no recession, no boom. We're in a new environment, really. And that means that he's flat out saying Fed funds could stay under 1% for the next 2.5 years. The only other thing I wanted to talk about was, hey, is this a model for picking individual stocks? No, it's the aggregate model. It's how large investors have to look at what are they going to do with their excess cash. Are they going to put it in bonds or are they going to put it in equities? And so if they have trouble picking individual stocks, they might just buy the ETFs. So it's not a model for picking individual stocks, but it is an argument for using cash and seeking excess return, as large investors will do. So this is what will continue to drive money into the stock market, and why, if we get another decent correction, it's not the end of the world. As long as there's no recession coming, you want to be a buyer of that, looking for S&P 2200 probably in the next 8 months. All right, that's it for me today in the kitchen. I'm Kevin Cook.